100K, 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 every day, we don't play, here to stay, we here to stay, concentrate, anticipate, it's okay,
Hello, my crypto juggernauts and family. Welcome to another episode of Mx3 Crypto Report, your destination for relevant crypto information when you need it the most. My name is Michael, and we have Mike.
Hey, everybody.
And we have Mark.
Hey, all.
And we are Mx3. Thank you for tuning in today. As per usual, please subscribe, give us a like, and hit that notification button and leave a comment. We appreciate your support as we continue to give you more valuable content. All right, let's head to what we're going to talk about today.
All right, let's do it.
What a shocker.
Yeah.
Interesting.
If you weren't awake before, they were awake now.
Ladies and gentlemen, we are going to dissect another video today. The video that we're looking into is, as in the description reads, what happens if a crypto platform such as Coinbase or Celsius goes bankrupt? And we're just going to give our opinions on this video and go along this crypto bear market journey with y'all and see if this type of information can provide the amount of value that could help all of us in this journey together. So, Mike, why don't we hit play and set this off?
All right, let's do it.
Banks are not your friends. That's Alex Mashinsky in the shirt, founder and CEO of Celsius, one of the largest crypto lending platforms. And on June 12th, his company surprised customers when it unexpectedly announced it was pausing all withdrawals, swaps, and transfers between accounts due to extreme market conditions. For reference, this year Bitcoin has lost more than half of its value, and another popular cryptocurrency, Ether, has fallen around 70%.
Celsius' decision to freeze customer accounts has rippled across the cryptocurrency industry. Shortly after its announcement, another Asia-based crypto lender called Bubble Finance announced that it is also suspending withdrawals.
Unlike banks, which are FDIC insured, crypto lenders like Celsius lack the legal protections that are built into the traditional financial system. And as the crypto market continues to tumble, many users of Celsius and the exchange Coinbase are beginning to wonder, if these crypto platforms go bankrupt, what happens to my assets? Celsius.
I would love to actually discuss that because personally, this has happened to me recently. So, what do you guys think? A lot of these platforms do not have the built-in protection that traditional financial institutions have. For a long time, we saw that as a pro. But as we're seeing now, there's some cons to that. What do you guys think?
Mark, would you like to go first?
Yeah, I was just going to say, I think it's a right along the same lines that banks were at when they first started out. They didn't have a lot of protections. They didn't have a lot of safeguards.
Right.
I think it's the same thing with the exchanges. They're just getting started. They don't have a lot of safeguards. They don't have a lot of experience in the area right now. But as they go along, as they start building, then those safeguards will be built into it. But right now, I think it's, I don't want to say the wild, wild west, but it's more of a risk right now because there's no safeguards out there. But no risk, no gain. I mean, you have to go out there because even though it's risky, it's everything is a risk. Every type of investment is a risk, whether it's stocks, bonds, real estate, crypto, everything is a risk. So we all take a risk once we look into any investment and try to invest. But yeah, I think right now it's a area that still needs growth and that still needs to progress in order to catch its feet and be able to stand on its own the same way that banks do now.
Okay.
I completely agree. You know, not your keys,
Not your
coins.
crypto. Yeah. Yeah. Yeah.
It's
Yeah.
the same way. It's just the
Yeah.
same way in everything, you know. If you go and just leave your keys out at the mall or something like that, maybe for your house or maybe for your car or whatever, you're allowing possibly somebody to come and open up your door and, you know, either jack your stuff or get away with it, you know. And so it's the same thing in crypto. And I like to tell people all the time, you know, before you start learning about all the fun stuff about trading and, you know, everything else, get your security right first. Get your security and know the basic concepts. Subscribe to Mx3 and watch our videos. We have so much on that, you know, so much tutorials and so much teachings. And we always talk about security here. And, you know, so the thing about, you know, Celsius is that, and these platforms is that most of the time they're custodial platforms whereby they manage your assets for you. And in that, you don't have your own keys. So once you give them your assets to be managed for you, practically they're not in your possession anymore. They're in the care of and in the possession of these exchange entities, you know. So it just goes back to it. Like, if you really want ownership of your coins, please take them out of the exchanges and hold them in your personal wallets, because these exchanges are not yet there whereby they're insured by certain government entities, such as the FDIC or something like that, whereby you can get some type of compensation if they do go bankrupt or insolvent in most cases, you know. That's all I can.
Okay. Good point.
I don't know if I can be more clear.
Oh, that's good. Good point. All right, let's get back to the video.
This is one of dozens of unregulated lenders and lending platforms that have emerged in recent years, touting high returns to investors who are willing to lend their digital assets.
Celsius promised customers annual percentage yields as high as 18.6%. That's a lot more than customers can get from regular bank accounts today.
Here's how that works. Customers deposit their cryptocurrency in the Celsius system in exchange for a yield. This is essentially an unsecured loan. And in order to earn a return, the company lends out assets to other users and puts customer deposits in often high-yield, high-risk, decentralized finance investments. When the system is working correctly, Celsius says that customers can expect approval for their withdrawals within 24 hours. But as cryptocurrency prices continued to fall, customers started to withdraw at a rate Celsius couldn't keep up with.
Celsius does not have enough liquidity, meaning readily spendable cryptocurrency on hand to hand back to the customers.
The company has since hired restructuring lawyers to advise on possible solutions for its mounting financial problems.
One of the financing options included a financial restructuring, meaning that the company could potentially file for bankruptcy.
And if that happens, users could face big losses. According to Celsius's terms of use, users that deposit assets in the Earn service grant the company a right and title to select.
Beautiful. So we kind of saw, I would have you scroll back, but just based on the time, like, we kind of saw in one of the diagrams how Celsius kind of made everything work within their system, right? So we saw a system in which a user, right, would give Celsius their crypto assets, right? Would loan their crypto assets, right? No, I think Is that the right term, Mike?
Yeah.
Is it
Yeah.
loan?
It's a platform where you loan your crypto, they invest it and pay you yields.
Oh, okay.
Yeah.
Okay. So you would loan your crypto to Celsius and they would give you yields back, right? Some type of yield back in a certain type of APY, right?
Yes.
Okay. And then in return, while they're housing your crypto assets, right, they would also play high risk investments with it, right?
Yes.
And at the same time also loaning it to another entity too,
Right.
it seems like.
Yes.
So it seems like they were just playing the game, but they were all over the place with it.
Yeah.
It seems like.
But it's again that's kind of the way it's structured, because they don't have enough liquidity. Once the market starts turning, they don't have enough liquidity to continue to pay out on a regular basis. That's the one thing. I started to pause it there too, but that was the one thing that stuck out for me. The difference between them or this type of platform in the crypto space and a similar platform in the traditional financial institution space is those funds are insured by the FDIC. So they don't have to have, in cases where they don't have the liquidity to be able to pay, you're not losing anything because the FDIC will cover you. But in these spaces, these types of spaces, if you don't have that liquidity, then you do what they did. They had to freeze people's accounts because they couldn't pay out. People were withdrawing faster than or more than what they actually had on hand.
Yeah. So basically they went insolvent, and then when they went insolvent, okay, so the assets are frozen. The assets are frozen, and they have also filed for bankruptcy.
Yep.
So what is the aftermath of that situation?
Well, they were from what I think, from what I saw, they were actually restructuring their company to be able to file for bankruptcy. Because the way the company was structured, like you said, it's not necessarily the Wild Wild West, but it's still new. So something like that, they didn't have a contingency for. So they had to restructure their company in order to be able to file for bankruptcy. And as they're kind of going over it now, if once they restructure, they start putting in little things in there that basically say, here's what happens here's what happens to your assets if this happens to the company. So they're restructuring things to protect themselves at the cost of their customers.
So I guess at this point, the customers can really just kiss their assets goodbye, right? Due to them filing for bankruptcy. That's what I'm trying to.
No pun intended.
I believe not.
But yeah, I mean, and that was kind of my point earlier. We rejoiced at this platform, and I still love this platform, but it leaves people vulnerable. It really does, and we've been seeing that a lot this year. I'll just mention, if anybody's familiar with CLTPS, and there's another one I can't remember the name of, but it was doing arbitrage in the same manner in which, in the manner in which we thought they were doing, like CLTPS, but it was just really kind of a shell game. When you pull the curtain back and you see what they're actually doing, they're not actually doing what they said they're doing. So it's, again, not exactly the Wild Wild West, but we're really starting to break some new ground here, and things are happening that haven't happened before. Yeah. And not only are us as customers having to have to make some adjustments to that, these companies are having to have to make adjustments too.
Absolutely. And we're also seeing a slew of, not just Celsius, a slew of these companies filing for bankruptcy, being insolvent, not being able to, rug pulls, not being able to pay their customers the funds back and stuff like that. So it's definitely bringing a whole new breadth of knowledge, a whole new breadth of experience to people within the space. And just once again, I will reiterate, not your keys, not your coins. Let's say it together, guys. Not your keys, not your coins. I don't know. Somebody in the back needs to hear it. But it's the same thing, It's unfortunate. It's unfortunate.
Such eligible digital assets, including ownership rights. That document also calls out bankruptcy explicitly, saying in the event that Celsius becomes bankrupt, enters liquidation, or is otherwise unable to repay its obligations, any eligible digital assets used in the earn service or as collateral under the borrow service may not be recoverable. You will likely not see a line like this in a user agreement for a bank, since most banks are FDIC insured. So what does that mean for users?
Based on Celsius terms of use, in the event of a bankruptcy, customer who deposited cryptocurrencies into Celsius accounts may not be able to get their money back because they would be considered essentially unsecured creditors. And even if they were to file for lawsuits against Celsius, they might not have a great chance of winning that legal action.
Similarly, the exchange Coinbase addressed bankruptcy in its quarterly filings, adding a disclosure based on SEC accounting guidelines released in March.
Coinbase made the disclosure that in the event of a bankruptcy, the digital assets that Coinbase holds for its customers may not really belong to the customers.
Coinbase noted that the new language in its financial report could lead customers to view its service as more risky and less attractive.
Coinbase CEO Brian Armstrong has come out and said that the likelihood of the company going bankrupt is extremely low, and the company is in very good financial conditions, but he made the disclosure just for the purpose of transparency.
Nearly 1 month after the bankruptcy disclosure, on June 14th, Coinbase announced it was laying off around 18% of its workforce. Armstrong said the decision was made to ensure Coinbase's health during this economic downturn. But if a crypto platform like Celsius or Coinbase were to go bankrupt, it wouldn't be the first to go under in that way. In 2014, Mt. Gox, then the largest crypto asset platform worldwide.
Say pause.
Yes.
Now go.
Just back to the what we're trying to discuss in this thing about what happens if these companies go bankrupt. How does it affect the crypto space at large? And due to the amount of time we have, we can probably end right here. Is that there's always in these type of spaces people that don't do their research, that they people that make themselves vulnerable. It's not your keys, not your coins and stuff like that. People that don't focus on the security aspects, people that don't read the fine print are unfortunately going to fall into how you said, Mike, the cannon fodder. Yeah. They're gonna be part of that 20% that become collateral damage within this space, as the space is still new, developing, growing. So there's always going to be a group of people, if they don't do their diligent research and they're not vigilant about what is going on within the fine print of the crypto space, they're going to be really affected by this type of stuff, And so that's why here at MX3, we always advise that you read the white papers, you do the research on these companies, at the end of the day, and you always try to protect your assets. Don't just look at your assets in regards to what the price is going to be pegged to the dollar or a fiat, but look at the assets based on what the productivity of these assets, the secure code, the team players. Look at these assets that if these assets were to be a commodity of their own or a currency, how would they fare against other currencies? You know, when I buy a crypto asset, I don't look at it as something pegged to a fiat. I look at it that I have that one crypto asset, and if I take it away, if I sell it or something, I don't have that crypto asset anymore. I see the power of the value based on that crypto asset alone, you know. And so once again, if Coinbase or Celsius was to go bankrupt, it's just the same thing with Mt. Gox, you know. But this is just history repeating itself again. It would cause a lot of sensation. It would cause a lot of market psychology, a lot of FUD. A lot of people would sell based on these type of events happening. But then there's a large wall of buy orders. You would sell, a lot of people would buy back at the lower prices, and it would be the same cycle again. This system is cryptocurrency is here to stay, but of course there's going to be a lot of people that you know, have Titanic-like events with it in this. It's happened already in the past. Mt. Gox, other institutions have fallen. It's happening right now. We're seeing Celsius and other institutions fall, and it might happen in the future again, you know. So don't be caught up on those Titanic events, on these catastrophic events. Know what you're gonna do. Read the fine print. Pray, have a little bit of luck in you, whatever you need, and try to just make the right decisions, you know, and try not to be caught up in the fast game, because a lot of these people, they're trying to play the fast game. They saw that Celsius was talking about this and a third APY that they're gonna get at this time really fast, right? And so they went in on it, instead of just simply doing the basic things that will get you your returns. And that's my opinion.
I just wanted to chime in on that a little bit, because whenever you invest, whenever you go into an investment, and just like you said, Mike, you want to be sure to do your due diligence, make sure that you read the white paper, make sure that you do all of your research, go into it eyes wide open. But even if you do your due diligence, even if you do all of that, because I'm pretty sure there's investors that did all of their research, did their due diligence, and invested with Celsius. Even if you invest with Celsius or Coinbase or any type of exchange, there's no guarantee that you're going to be successful. There's no guarantee that you're going to make money. There's no guarantee that you're going to come out on top. You could do a lot of due diligence and still not succeed the way that you want to succeed. But you want to be sure to keep that philosophy in mind, to never invest more than you're willing to lose, because nothing is guaranteed. No investment is guaranteed. No stock, no bond, no cryptocurrency, no real estate. Nothing is guaranteed in life. So be sure that you keep that in mind, to never invest more than you're willing to lose.
Yeah, that's a great point, Mark. And I just, my points on that are, a mentor of mine recently reminded us all, when you go into things like this, have a strategy and have an exit point. You know, go into it understanding what you're looking to get out of it, what you're looking to gain, and have an exit point. You know, a lot of people, myself included, I've gone into investments without a strategy, without an exit point, and just kind of riding the rapids, so to speak. You know, and a lot of times when, especially like this company, 18 plus percentage points in yield.
Yeah,
you want to ride that horse until it dies. You know, you're tempted to do that.
Yeah,
but you have to have a strategy, you know, for your investing and an exit point. And then also, lastly, take profit along the way. You know, because again, you know, trying to maximize your profits, leaving all that in there is not always a good strategy, you know, as we're seeing here. And I know a lot of people can relate to that. If you were on Celsius or some other platform and things kind of would belly up. So that's just my 2 cents.
I totally agree with you, Mike. And I don't know, I wanted to, this sexual innuendo came into my mind.
Uh-oh.
Hey, hide the kids, y'all. Like whereby, you know, some people like they want to stay in for so long and their pullout game is so weak. And so they're just enjoying themselves in the crypto market. No exit strategy. And then boom, they get knocked. You know. So you gotta have a great pullout game. You gotta know when you want to get out. Otherwise,
well, you know what? If it's apropos, it's apropos. It fits. It fits the situation. It fits the situation. So,
oh man,
Oh my goodness.
Well, on that note, we're out of time. So let us wrap up.
all right.
Okay, awesome. That's all the time we have for today. Thank you so much for tuning in. We really appreciate you. Please do not forget to subscribe, drop a like, and hit that notification button if you haven't already done so. Also, kindly leave some comments in the section below. Thank you so much for tuning in once again, and we'll continue to give you that relevant crypto information when you need it. Thank you. Peace.
Be blessed.
Take care, everybody.
Tomorrow can be a better day if you're looking to get some figures for better pay. Invest in yourself, man, that is the only way. Get your club up, 100K followers. How you do that, man? By not being a follower. How you get there, man? Hustling and bustling. Then you spice it up, put some brain muscle in.